Hello and welcome to one of the video tutorials of Forex ID Academy series. We are looking at a chart with a GBP USD pair, 4-hour time frame, and it's 28 minutes past midnight GMT. I have a setup with Bollinger bands. This is the medium line, which is the 20 period SMA, simple moving average, and this yellow line is the exponential moving average of 10 periods. Okay, so I wanted to show you using both candlesticks and price line, which is the correlation of the 10 EMA with the upper Bollinger band here and the median Bollinger band, the SMA, the 20 SMA. Why this is important? Because it will help you position yourselves. It will help you find, spot your entries and your exits, and you will see that in most cases the 10 EMA acts as a support or resistance level. Let me show you the actually here we have an upward move, we have a bullish move, but you shouldn't enter before you see the price retracing to the 10 EMA level. Around the 10 EMA level, check the candlestick formation, check the price action, and position yourself to go long, to enter long, because what the Bollinger band saw is that the volatility is going to increase, and the bullish trend shows that is the dominant trend right now. Let's see the price action represented by the line, and you will see why this is important. Let's observe something together. Watch every time the price was moving downwards and we had bearish move, how it was between the yellow line and the lower Bollinger band. The price action is the green line, okay? So watch how the green line has been between the yellow line and the lower Bollinger band, and if we go to this this huge uptrend, watch how many times the price line bounced back from the yellow line, which is the 10 EMA, and it was going up and down between, there was a channel formed between the upper Bollinger band and the 10 EMA. The same holds true for previous price moves. You see? So even if the price was forming swing lows below the SMA, the 20 SMA, and the yellow line, the 10 EMA, it was entering again the tunnel. What does this mean? And please watch something else. That every time that the downward move was increasing and the momentum was increasing, the bearish momentum, the space between the yellow line, the 10 EMA, and the median line of the Bollinger Bands, which is the 20 SMA, was increasing. We had this increase in this space, which makes the trade worth taking. And let me show you the same. Look how we had that increase on trades which were worth taking long, and look here how we have this consistent distance between the two. They are almost parallel, and that shows beyond doubt that the uptrend is on a continuation mode. Now, I believe that by observing, we can find out, we can evaluate a tremendous volume of information which otherwise slips the eye. Since the price line represents the closing prices of the candlesticks, it doesn't show actually that some candlesticks here touched the line, the upper Bollinger Band, and went above it, and then they went down. But if we go and choose to see what actually happened with the candlesticks, we will see that they touched the upper Bollinger Band. See here? So every time you see an acute angle like this, forming, touching the opposite Bollinger Band, and when you see that on the price line, the price action, not using the candlesticks, but simplifying your view, get prepared to position yourself short. When you see the same pattern of the price line on the lower Bollinger Band, get ready to position yourself long. And as I already explained in a previous video, if the price line goes straight and crosses and is almost vertical when it meets the 10 EMA and the 20 SMA, then we are more than sure that it will go to the opposite, it will touch the opposite Bollinger Band, and then we can reverse our position and get ready to go short. Okay? Just watch those patterns. So, what do we have here and now? We have, which are the signals we have that show us that the uptrend is strong and it's going to continue. First, if we watch the two Bollinger Bands, their edges, we see that they are opening, and while the upper one is going upwards, the lower one is creating a knee, which knee is similar to the one we had here on this outburst of an uptrend, Again, the bar was going upwards, the upper band, and the lower one formed the knee, and then it started running on a parallel orbit to the opposite Bollinger Band. Let's watch for something similar here. Second, we have the 10 EMA, the yellow line, and the 20 SMA, the magenta, the purple line in the middle, with a space between each other. And we see here a crossover, and the crossover is bullish, and we see a space opening instead of closing, which means that the uptrend holds strong. We should expect this downward move, which is a secondary move, to find resistance, to find support. That's the right word. To find support on the 10 EMA. So we must get ready to position ourselves long when this support is touched. How can we be precise about the entry point? There are many ways to make it to fix the entry point. We can use the Fibonacci retracement levels. We can use the daily pivot levels. We can use the confluence levels. If we go to see the Fibonacci levels on different time frames, and we see that there is a confluence there, or we can see the same on pivots, or a combination of pivot levels and Fibonacci retracement levels, then we can choose the position where we will enter, and we can put our stop depending on our wallet and our account's tolerance somewhere close to the 20 SMA, or between the 20 SMA and the 10 EMA, depending on our tolerance. The higher, the wider our stop loss zone is, the better, because it allows time, it allows space to the trade to breathe and to move. So I am against fixed stop losses of 30, 40, 50 pips. I don't believe that there is a standard rule about that, or that any trade is the same as anyone else. Every trade is unique, is totally unique. So you can judge by the market conditions at the particular time that you're entering, and see the volatility and see the momentum and take them under consideration. But the general rules are given here, and you can test them first on a demo account. Make sure you have understood them, and then start applying what I'm showing here on your live account. Let's go back to the candlestick view. So I believe that now you have one more tool in your arsenal to use for your trades. Remember, this is a 4-hour chart, a 4-hour time frame. the same rule applies for smaller time frames and also for bigger time frames. Try to practice watching the price action using the line instead of the candlesticks, and then going back to the candlesticks to get to confirm what you saw on the line, which I believe is simpler and easier to understand. So thanks for watching and happy trades.